What up, guys? Welcome back to a Monday night chill, a chill session. So today we're looking at Stake, which is the stock buying platform, self-brokerage application that you can get on Android and Apple Store. Not affiliated, not a paid video. Just thought I'd take a look at it, review it, because I have been spending a bit of time on it. I've been really into investing. Or at least doing a lot of research and self-education around the whole idea of investing, so that when I'm ready to retire, not just ready, but when I'm able to retire, I have a few income streams ready to go, so that me and my wife can, retire comfortably, live happily within our means, knowing that we're safe financially. So that's been the focus for the last few weeks, just balls deep in self-financial literacy and all that good stuff. So today we're going to talk about Stake, look at some ETFs, look at some Vanguard stuff. I am by no means a professional finance guy. I'm just doing as much research as I can, self-education. At the ripe old age of 38, I'm trying to wrap my head around all this stuff, and YouTube is such a great resource. So anyway, today we are listening to Relaxation Day, no copyright, lo-fi beats to relax to from Stomp's playlist, bringing you the chilled out beats that you are listening to now. All right. So with that said, let's take a look at Stake. So Stake is the platform that I've been using for the past maybe 1 or 2 weeks, probably 2 weeks. And there's a few self-brokerage accounts out there. Let me see, self stock brokerage platforms, Australia. Okay, bunch of typos out there, but 5 best online brokers for Australia 2022. So CMC markets, I've read a lot about that. So this is for the Aussies, okay, for the Australians out there. Sorry if you're viewing from another country, you might just have to chill and relax to the music or something else. But yeah, this information may not be pertinent to you guys. But CMC markets is one of the big ones. IG, I haven't heard of IG. CommSec, everyone knows about, because that's the securities branch of Commonwealth Bank. Okay. Oh, the ones that I use are not on here. So Self Wealth is a big one. Let me see, finder.com. CMC markets, eToro. People heard of eToro. Superhero is another one. So Superhero is zero brokerage on US stocks, $5 on AXS stocks, zero brokerage for ETF purchases. So that's a big one as well. But I think Superhero, people said that you don't own the stocks yourself. Technically, what happens is Superhero buys the stocks on your behalf, and they have custody of it. Whereas if you buy through certain other platforms like Stake, for example, you get your own HIN. What's a HIN? We looked at this before not too long ago. Holder identification number. Okay, so you get your own HIN, which means that you yourself have bought the stocks. So it's people believe it's an extra layer of security having your own HIN, as opposed to something like Superhero where they buy on your behalf. But it is what it is. It's up to you. Do your own research. Again, this is not financial advice. This is just me doing some self-education, educating myself on financial literacy. So this is what we're doing today. All right. So with that said, let's take a look at Stake. So I've been messing around with Stake. Okay. So far I've put over $1,000 into it. Just a bit of spare change that I have in my account. I've been pretty prudent with my spending so that I can put money into understanding stocks, ETFs, and all that good stuff. So far what I have bought is I bought 7 units of the VAS what is it? VAF ETF. Okay, so VAS is Vanguard's Australian Shares Index. So this is www.2.asx.com.au in case anyone's interested. So 7 units of that bought at an average price of $82.43, and since buying it, I'm up $12.95, but on a day-to-day change, it's down 0.14%. So technically still up. Now, if you watch a whole bunch of videos by all the finance guys on YouTube, then you'll hear this over and over again that during a recession, during economic slowdown, this is usually the best time to get into stocks, because a lot of millionaires are made during this time, right? You buy when blood is on the street. So I've put in another pending order for VGS. So let's just look at VAS. Now, people say that obviously you want to diversify your account. So VAS is the Vanguard Australian Shares Index, which focuses on the top. So it's heavily focused in Australia, obviously. So 95.98% of its exposure is in Australia. Now, they hold a whole bunch of holdings. Top 10 holdings is BHP, Commonwealth Bank, National Bank Limited, Westpac. So they hold a lot of finance. And here is, I think these are considered commodities, like Woodside, Macquarie Group, Wesfarmers, Telstra. So like I said, I'm not a pro, and I'm just learning as we go along. But they hold all of everything mostly in stock. People say that they don't want exposure to bonds because it's like not a lot of growth. But so most of it is in stock. Nearly everything is in stock. Market capitalization is greater than $1 billion. So here you go, the breakdown of category. So mostly in financial services, basic materials, next is healthcare, and then portion real estate as well. So if you can see the total returns for the past years thus far, as we know, it's been a difficult year with the stock market and the crypto market being in a bear market. We are down 6.46. So over a 3-year period, there's a positive return, but obviously you want to hold over the long term, and you shouldn't be so focused on 6 months or 3 months unless you're a regular day trader. But even then, you wouldn't be trading ETF stocks, right? You'd get your own. You'd be buying individual stocks for that. So 5-day trading volume, here you can see that there's good trading volume, because you want to be able to liquidate your account if you needed to, knowing that there's enough liquidity in the market on these ETF shares. Okay. So when did I buy in? I bought in at $82.43. $82.43. So in the past 52-week range, I'm towards the low end, which isn't too bad, right? So the lowest it's been in the last 52 weeks, last year, has been $80.45. I bought in at 82. So that's not too bad. And the highest it's been in the last 52-week range is 97. So like I said, it's kind of in the bear market when everything's really slow. You know, people are talking about recession, people are talking about hiking interest rates. So everyone's really worried, and a lot of people selling, taking their money out, holding cash just for emergency purposes. And you can see here, all right, this chart, the dividend that's been paid out, I think it's every quarter. It's October, January, April. Last one was in June, July period. 1st of July there. And as you can see, it's down on a slump. So this is a Australian focused one, and as they said, you should diversify. And the other one that I've been looking at is the VGS, which is the Vanguard International ETF. Okay. So the last price on this was 91, and as you can see here, there's a pending order for 6 shares at $91. Last price was 91.16. Okay, so hopefully it hits that and I'll be able to buy 6 units of that. So the VGS is focused heavily on, I think, the US market, or at least, yeah, well, 69% is exposed in the US, next highest being in Japan, and then you got United Kingdom, so forth, so on and so forth. So biggest holding here is Apple, then you got Microsoft, so you know, the big names that you would expect. So there's a scattering, and they hold a total of 1,463 companies, so that's a lot. If people think they don't want to be exposed to that many companies because you only own a small portion, then you know, you can buy the individual stocks yourself. But by diversifying like this, you know, you kind of spread the risk across. So again, most of it is held in stocks, good market cap, and a lot of this ETF is in technology, whereas before with the VAS, the Australian Shares Index, that was heavily in the financial sector. Okay, so they're the two that I'm kind of buying into because I've done a bit of research, and people said, like, if you want to get into something that's set and forget, that you don't have to think about, that every so often, every week, every month, you just put money in and you just spread the funds to buy ETFs, then VGS is good because you're exposed to the Australian market, and then VGS you're exposed to the international market. And then they say you may want to expose yourself to VAE. Now there's different versions of these ETFs, right? BlackRock might have some. These are like investment companies, fund managers. Like BlackRock might have, BetaShares might have their own version. That administration fees may change depending on who you go with, but for the most part, you may find that there's a bit of overlap between the VAE Asia and you know, other funds version of Asia ETFs. So this one tracks emerging Asian market, and last price on this was $66. And you can see here the total returns in the past year, like I said, bear market and really being hit by just macroeconomics, global geopolitical economics, right? Like with the war and with Asia really not doing too great in terms of what's happening with China and the pressures there. You see that in the past year, 12-month return is down 17%. Again, because it's Asia, you would, you know, rightly assume that it's kind of heavily focused on technology. It is in this case. And then the financial sector being the next highest exposure. It's kind of even, right? 19.8, 20.69. And again, in stocks, China being the most heavily invested with 38% of exposure being in China. And then India, two of the big ones that you'd expect. Then you got South Korea and Taiwan. Taiwan, I imagine big exposure there because of the microchip industry as well. So Tencent Holdings, Taiwan Semiconductors, Alibaba, Samsung Electronics. So the usual suspects that you expect in an emerging Asian market. So if you're looking to spread your risk and diversify your account, then VAS, VGS, and VAE apparently are good options. Again, not financial advice, just stuff that I've been researching and looking into. Now, if we go back to our stake, this platform is easy enough. What you see here is a little bit different to what you get on the mobile application. So essentially, it's an easy process to sign up. You know, fill out the online application thing, send in some details, you know, image of yourself, some identification like license details and whatnot, and they'll approve you within, I don't know, 48 hours, and then you'll be up and running. You'll link your bank account, and they'll give you your own BSB number, your branch number, and your account that's dedicated on stake. And pretty much you can set up a regular direct debit or some kind of debit regular transfer structure where you don't have to think about it, which is what I've done. Every week I've just like push over $20, and on the random occasion I'll put a few hundred as well, just to top it up. But the downside, which I found out, and I don't know if this is across other platforms as well, but when you first buy your into a share, like when I first bought VAS and everything else that you first buy into, you need to put a minimum order of at least $500. So that's, and then after you do that, you can kind of buy however much you want, like smaller portions. But yeah, initially when you buy into a new ETF or a new company, you have to buy a minimum of $500. And then if we look at for the Aussies out there, how this compares: $3 brokerage fees across 2,000 shares and ETFs. So if you have an account on Superhero or Perla, then it's 0 fees to transfer your portfolio over. And I believe that if you transfer your portfolio that's worth more than $1,000 over to stake, it's, I think, 4 or 12 months you get like free brokerage fees. Okay, so they are CHESS sponsored, meaning that you do get your own HIN, you get your own holder identification number. So it's not like Stake buys it on your behalf and holds it as the custody. So here you go. So $3 brokerage between trades that are $0 to $1,000. So pretty much just $3 across the board, right? And if you look at ComSec, it's $10 per trade. And then it gets exponentially more depending on how much you buy. Self-Wealth is another one that people talk about, and that's $9.50. And still, that's a lot, especially for someone that doesn't buy in huge amounts. If you would drop like $5,000 or $10,000 on a trade, then yeah, okay, it's not too bad. But when you're buying like me, minimum 500s, then $3 is okay. I can deal with that, right? So if we go to the Wall Street, so with Stake you can also buy international or American stocks as well, and 0 brokerage fees on trades for the US Wall Street market. Okay, and this is how they compare with the other platforms as well. So it's, as a novice, as someone that's just wanting to get into it and never experienced it before, the whole process has been pretty seamless, and it's, the layout's really clean. The phone application layout's really clean too, really easy to understand and simple, right? Black on white background, so clean. And you can get to make your own watch list, and this is my current watch list. I've got Rio Tinto because I want to buy. These are things that I want to potentially look at buying. I wonder what does this mean? Why is there a megaphone? Is there an announcement? Ooh, change in substantial holding. Oh, that's cool. It's kind of cool that they have all these announcements in that one page. So JB Hi-Fi is that retail that focuses on consumer electronics, right? All right, let's see what this is about. This announcement is about. I also want to buy ANZ shares as well, but as you can see with the VAS, which is focused on Australian companies, they're heavily focused on the financial sector, and they already have holdings in ANZ and all the other major banks. Okay. Changes in relevant interests. And this is the thing, right? Once you start investing, it's like, how much of this do you need to know and how much do you need to understand? Who does all these readings? Like, do I need to know all this stuff? That's the problem, right? So yeah, I was just thinking of buying JB Hi-Fi, Fortescue Metals, and ANZ. Wow, down 2% because of probably this announcement. But yeah, you can kind of create your own watch list of 15 shares, 15 ticker thingies. The other one that I was looking at was also the Vanguard High Growth ETF. But I did read somewhere that there's a lot of overlap. If you have VAS, VGS, then you don't want a VDHG because there's a lot of overlap with that. So let's just take a look at VDHG. The whole point of this is you want to spread your risk. There's no point buying into ETFs that have very similar, if not the same, holdings because, well, it's the same holding. So heavily focus on finances, then tech, then basic materials. A mixture of Australian and United States. Equal share, pretty much equal, like 36, 37. Right. So yeah, they hold VAS anyway, and then they hold VGS anyway. So it's like, why would you buy this? You probably just want to buy this one itself and then buy individual companies if you didn't want to buy VAS and VGS separately. So yeah, if anyone wants to try stake, then happy to use my code DavidL225 and just check it out. You know, you scratch my back, I'll scratch yours. But yeah, the whole point of this is just to steadily grow a portfolio. So I have something, right? I've been watching a lot of like interesting channels, educating myself, and I did comment. I was just like, I feel like I'm behind the 8 ball. I feel like I've been so just not focused on financial literacy for so long. But I commented that I appreciate, you know, the informative videos. It's fantastic. I'm binging on them, but I can't help but feel that I've been kind of left behind, or not left behind, but I'm a bit late to the game. And the owner of the YouTube channel responded and was very nice about it. He was like, the best time to grow a tree was like 20 years ago, but he wrote something. I should find out what he wrote. He said something really nice. Oh yeah, Quan Tien replied, "I'm glad you're getting something useful out of them. There's no such thing as learning late. The best time to plant a tree was 20 years ago. The second best time is now." So Quan, he makes great content. So yeah, being really not down on myself, but acknowledging the fact that yeah, I'm a bit late to the game when it comes to investing and building the portfolio and building that financial independence from the system. But we are working on it. We are getting there, and Stake is one of those platforms that I'm using, and it's pretty easy to put in a trade. So if I go to my watch list and let's say I want to buy some ANZ, Australian New Zealand bank shares, so you just put in a limit order saying that you want to buy, I don't know, 10 shares, right? This is the number of shares. At what price? So right now it's at 22.62, right? That's the closing price for the day. So you can say that you want to put a buy order to buy 10 shares at $22, and should it hit $22, then your order will fill, Okay, it will fill only if there is a person that's willing to sell it at $22. Okay, so even though the price might hit that, it doesn't mean it will sell straight away. There has to be a sell order within the books for someone that's willing to sell 10, or multiple people willing to sell a portion of their shares at that price. Okay, and it'll automatically fill it for you. And here you can set the expiry for 30 days or whatever. I think the max was 30 days. Yeah, so expires 30 days, or you can do at the end of the day. But yeah, that's how it works. That's pretty much putting in an order. You can enter the amount of dollars to purchase as well. So that's kind of like fractional shares. You can buy a percentage of a share by just putting a dollar amount. But yeah, now it's just a matter, now that you've set it up and you understand it, it's kind of just a matter of doing your research and understanding franking credits, and understanding tax implications, understanding strategies, monitoring the market. Though again, I mentioned that ETFs are usually set and forget. So I feel like I've got at least, 15, 20 years left in me. So it's a kind of set and forget. If they pay out dividends, then you kind of just compound those dividends. It's also good to educate yourself on dividend reinvestment schemes. I think they're called programs, dividend reinvestment programs. I think they're called DRIP, where you can get the dividends paid out, and then you can tell the company or the index fund to just reinvest it. And from what I read is sometimes when you reinvest it and you use your dividend, because you're using your dividend, you can get a small discount. But yeah, you guys should double check that. But yeah, it's the power of compounding, right? It's like the dividends, you get paid for owning part of that business, that company, as a stockholder, as a shareholder, and then you just reinvest it back in the business. And if you do this periodically, especially if they provide dividends every quarter, right? If you do this periodically over 10, 15, 20 years, you can see how it can all potentially add up. It's passive income, right? Obviously, there's a portion of tax that you pay on it, but yeah, it's important to kind of look into that stuff too. So that's pretty much what I've been really heavily focused on in the past couple of weeks. And it's my ambition, it's my goal to kind of build this fund up and really pass on any knowledge that I build through this process to my wife, my family, my kids, so that they can break the cycle of financial illiteracy. So there you go, guys. Oof. Didn't feel like that was a very chill session at all. I felt that was a very information dense and heavy session. But I hope you guys are doing well. See, the hard part about this is kind of staying up to date with everything and trying to understand the financial side of stuff. And where do you go? Like, I don't know, where do you go? Let's just go ASX. Where do you go to do your research, right? Daily market wrap. Oh, and also, like, talking about diversification, like, people also have ETFs. There's ETFs that focus on technology groups as well, and one that pays regular dividends that people have been talking about, like good dividends, are like REITs, which focuses on property. REITs Australia. What are REITs? Real estate investment trusts. So REITs, or real estate investment trusts, provide investors exposure to the property market through stock portfolio. Similar to managed funds, REITs are actively managed and pull together investors' money to invest in properties. REITs typically invest in commercial properties such as offices and apartment buildings, shopping centres and hotels. In Australia, REITs are known as AREITs, and they are traded on the AXS. Generally, the minimum initial investment for a REIT is $500. So yeah, I need to kind of find what is a good REIT. I read that VAP was one of them, Australian Property Securities Index, or I don't know if it was good, but it's I mean, we're sticking with the whole Vanguard theme. I think it was potential, right? Let's look at a yearly chart, and again, it's we're looking at dividends, right? So that's the chart. Look back in, wow, really crashed on this day around March, April 2020. May have been COVID, yeah. So a big COVID crash, right? Because if you think about COVID, what happened around this time in commercial real estate, especially when it comes to REITs focusing on commercial real estate, like everyone went out of business. Everyone couldn't afford to pay their landlord or their the business rent anymore because, well, everything had to close down. It was forced closure, right? So it would have been a fantastic time to buy in at $51, right? Get the dividend as we go, right? And not only do you claim passive income through the dividend, but if had you bought at $52 at its peak, it was $101 back in December 21, right? So you made a decent gain there, but you kind of just hold on. Even now that it's dipping, it's in the 79 range. So over a few years period, you're getting passive income and you're building capital gains as well, hopefully. So yeah, VAP is apparently one of the good ones as well, or one of the ones to look at as well. It is focused heavily on Australia. There you go. So I might look at VAS for Australian exposure companies, VGS for international exposure, VAE for exposure in emerging markets for Asia, and the VAP to round it off with a focus on Australian property and securities. So there you go. That's what I'm thinking. I don't know if that will work. I don't know if that's a good plan, but I'm talking about a 10, 15, 20 year plan to grow it. And we'll just go from there. Not only that, on the side, we'll be focusing on cryptocurrency and what will happen in that market. I can only imagine that crypto is going to be something that people are trading on now. Especially when it comes to money, people just want to make quick money, easy money, and crypto is still seen as an avenue for that. So it's always going to be bringing in interest as well. So there you go. That's the journey so far. I hope you guys were able to chill and relax with me. I do these sessions at night and I'm getting tired. But I really enjoy these sessions because they're like free-flowing sessions. There's no pressure to deliver great content. I mean, I do want to, but if I don't, then I don't. I want to bring you into the back end, the secret layer behind YouTube analytics and YouTube studios. Now, as you can see, I have 8,000 subscribers. It's such it's so deceiving, right? Because 8,000 was built up during the big NFT boom, and now that I don't make NFT project videos anymore, I dare say 7,500 of those people, you know, were interested in NFTs, and now that I don't make any, they're slowly drifting away. Because if you see the amount of people that watch my videos is nowhere near the thousands, right? So it is quite deceiving. And the remaining 500 or so are probably Earth 2 people, which again, I'm not heavily focused on at the moment either. Sometimes I create it. So this number is very, very very, very deceiving. And at its peak, at the NFT boom, when I was getting like thousands of views on some of my NFT videos, I was making like $500 a month, which isn't too bad, especially, if you reinvest it into, stocks or something like that, or ETFs. But now with the channel going where it's going, estimated monthly revenue is like $40. And I think YouTube doesn't even pay you out until it reaches $100 anyway. So it kind of accumulates over the months, and once you reach $100, they'll pay you out in your account. But I just wish this wasn't so front and center, because I think people get disheartened by this number when they see it growing or diminishing, and like, it's so typical, -4 in the last 28 days in red. And I find it so comforting knowing that who cares, honestly. Even if this dropped to 0, I would feel like a weight is lifted off my shoulder, because like, you're not driven by that number anymore. Like, I personally am not driven by the number anymore. I was at one point in time to reach monetization, but once you reach that point, it's like you find that the pressure on yourself it either drives you, motivates you, or stagnates you. And for me, it motivated me up to a point, and then it became more of a try to keep the momentum going, but if it doesn't continue, then that's still okay. Just do something that you enjoy doing, because then it won't feel like a chore, doesn't feel like work, doesn't feel like a painful experience to try and come up with content. What am I going to talk about? What am I going to say? What am I going to do? How do I make it glitzy? How do I make it glamorous? How do I make it entertaining? Should I do the thumbnail? Like, all these things, right? But now I just get to do these chill out sessions, which is really good, because I get to sit back in the evening and just talk about whatever. Anyway, appreciate you guys hanging out with me, and I'll see you in the next chill out session. All right, bye.